What's up, guys? Today we're going to be breaking down AppLovin stock. I am an owner of AppLovin stock and I'm actually a bag holder. I bought around the $400 mark. After Q2 earnings, they collapsed 25%. So I am a bag holder. However, I do still think that the fair value is $625. And I'm going to go over my reasoning and my discounted cash flow model in just a minute. So stay tuned for that. We can see here by the waterfall chart how profitable they are. We see that the revenue is 6.8 billion for the trailing 12 months, and we can see that the red bars are their cost of goods sold and their operating expenditures, basically the cost to run the business. And we see that the 5.3 billion of operating income and 4.4 billion of net income. So basically over 70% of the revenue is profit. So that's pretty good. We can take a look at the PE versus the stock price. PE is actually very low compared to the past, and the stock price is also low compared to 2025. It went from $674 down to $312 right now. Let's see revenue and earnings. We can see everything is going way up into the right, as we can see here. So that's what we like to see. And operating income and cash flow statement. Let's see. We see CapEx staying at 0 million. So they're very efficient with the platform they have. One of the risks of this stock is basically they have no competitors right now. There's just a monopoly in the mobile gaming space. And their plan to grow in the future is expanding their e-commerce advertising business and into TV advertising as well. So they've already mastered the mobile gaming. They have complete dominance in that. The way they actually do make money, that they operate on two sides. Basically, there's a publisher side and then you have the Max. Max is the supply side platform. If you own a mobile game and you want to sell ad space, you use their Max platform to run the auction. And on the other side, you have Axon, which is the demand side platform where the advertisers live. Here's the secret sauce of AppLovin. They make their money on the spread. Let's say an advertiser knows their lifetime customer value and is willing to pay up to $20 to get a user to download their app. That budget goes into Axon. Meanwhile, the publisher's ad slot goes up for auction on Max. Google bids $10, Meta bids $11, AppLovin Axon algorithm steps in and bids $13. Axon wins the auction for the advertiser, but remember the advertiser was willing to pay $20. AppLovin pockets that $7 difference as an arbitrage. So that's how they make their money right now, and the worry is that there's going to be a competitor and they're going to come and take a part of that $7 arbitrage. So let's continue with the margins. So all the margins are going up and to the right, except for free cash flow, taking a slight dip. Gross margins are the highest they've ever been. Operating margins, highest they've ever been. Net margins, highest they've ever been. So did that really justify a 25% Q2 drop? I don't think so. Also, they might have lowered guidance a little bit, but the plan is always to beat guidance, like raise and beat. So if they lower it for the next quarter, then they're going to beat it. And then everyone's going to change their price analyst target. So it's pretty funny. Let's see. Now we got the balance sheet and we see net debt is all the way going down. And tangible book value is 1.2 billion and going up. Now we can look at the historical financials. So net debt is 462 million. So that basically means they only have 462 million of debt. So to run the discounted cash flow model, we use these purple numbers here. This is the year-over-year revenue growth, and then we use the operating margin right here. And it has definitions right here if you guys need to learn the definitions of anything. And then we have free cash flow margins right here and EV to EBIT multiple right here. For my bull case, I put 35% revenue growth and 81% operating margins compared to our 77 and 65% free cash flow margin. That's the trailing 12 month is 62%. And then the multiple going up to 25. We can see their historical multiples around 86. With these assumptions, you get 47% return per year if you hold the stock for 5 years. And we can have the terminal value bridge. This basically just shows you the math of the discounted cash flow model right here. We would get a per share fair value of $12.68, 4 times what the price is right now. So this is assuming like that the e-commerce and the TV advertising goes all to plan. Like the CEO said, they want to be a $1 trillion company. And we can see the base case, I put 15% revenue growth. So keeping operating margins the same, assuming no competitors take over their ad space. And then 62% free cash flow, keeping the multiple around 20. And that would give you a 19% return on your money if this scenario plays out. And then the bear case, I'm saying an advertiser comes in and cuts that spread in half. So basically going from 78% to 40% operating margin, and free cash flow drops to 55%. We can actually even change it to 41%. Let's just say that what Q2 earnings was. And then their multiple drops to 15. Because they are so efficient, I think they deserve a good multiple. I think their multiple is low for their growth rate right now. 6% year over year revenue growth, just assuming like the advertiser competition really picks up from like Google or Meta or somebody. We see that there's 95% upside with my discounted cash flow models. If we merge them all together with probabilities, I'm not taking any stance here. Let's say the probability is 50% that the competition picks up, just to be on the conservative side. We still get a true IRR of 21%. So that's really nice right here. You see the true IRR and the fair value of $500 per share. And that would give you an upside price of 57%. But let's say the bull case plays out and things go to plan like the CEO says, then we would get a 47% internal rate of return and then a upside price of 300%. This part of the discount cash flow model is pretty cool because you can see at different prices what your return would be. So I bought around $400, like right here. So I just saw that bull case scenario. If that bull case scenario plays out, then 40%, that is absolutely insane. And I'm okay taking that risk for that bull case because I'm up so much money this year that I don't mind if I take a small tax loss. And I think that AppLovin CEO management, they're really good. And I respect that they're trying to run a very lean and efficient business. If we quickly look at the margins compared to other companies, we see that AppLovin beats almost everybody. And I don't see anything where AppLovin loses to anybody else. We're looking at like Google, the Trade Desk, Meta, and Reddit. Rule of 40 really stands out for AppLovin, 138%. Top line growth, Reddit wins. And let's take a look at the valuation multiples. Basically, you want to see small bars on the valuation multiples. You see Trade Desk being the smallest, but their revenue growth is actually really decelerating, and their profits are as well. And now we can see the profit per an employee, where AppLovin is just smoking everybody out here. Google's profit per an employee is pretty impressive. Same with Meta, and Reddit's actually growing as well. Check out my Reddit video if you haven't already seen it. Then we can see all these other data there if you feel like. And we can see in my portfolio how much I actually hold of AppLovin stock. You can also track your positions based off your discounted cash flow models on the portfolio tab. And that would be right here. You can see the blended IRR is 29% for AppLovin. Kohl's stock is 27%. Reddit stock is 22%. ADT stock 23%. Comcast 20%. So these are all stocks I currently hold. And I try to always get a 20% or higher blended IRR. But let's say I buy a stock and it was a 24% and it's gone up a lot, then I'll just kind of hold that stock and try to avoid paying lots of taxes unless the thesis changes. This is my current portfolio holdings, and every time I buy or sell stock, it will automatically update on my Discord. You can subscribe for $3 a month, and it'll automatically post updates on what I buy or sell automatically, which is a pretty cool thing. Dude, vibe coding is insane. I love it. You can subscribe to my website for free. Check it out. You'll get all these features and even more I didn't talk about in this video. So thank you guys for watching. Check out the Reddit stock I just made today, and I'll see you guys in the next video.